In the landscape of corporate America, some stories stand as towering monuments to ambition, while others serve as grim reminders of its perils. This is the story of WorldCom, a telecommunications titan that built an empire on a foundation of lies. At the dawn of the new millennium, it was a symbol of the dot-com boom's boundless potential. But behind the soaring stock prices and bold proclamations, a secret was festering, a fraud of such staggering scale it would shatter records and shake the financial world to its core. This is the story of an $11 billion deception, a CEO who traded his throne for a prison cell, and the few who dared to expose the truth. This is the fall of WorldCom. The story begins with Bernie Ebbers, a former basketball coach with a folksy charm and an insatiable appetite for growth. Starting with a small long-distance reseller in Mississippi, Ebbers transformed WorldCom into a global behemoth through a relentless series of over 60 acquisitions. By the late 1990s, WorldCom was the second-largest long-distance provider in the United States, a darling of Wall Street that seemed to defy gravity. Investors flocked to the company, captivated by its ever-climbing revenue and the charismatic leadership of its CEO. But the dot-com bubble was about to burst, and the telecommunications industry was facing a downturn. The pressure to maintain the illusion of unstoppable growth was immense. For WorldCom, meeting Wall Street's quarterly expectations wasn't just a goal. It was an obsession. As the new millennium began, WorldCom's revenue streams started to dry up. The market was saturated and the company's profits were declining. For CEO Bernie Ebbers and his trusted CFO Scott Sullivan, this reality was unacceptable. They had built a reputation on delivering double-digit growth, and they were determined to keep the music playing, even if it meant inventing the notes. The scheme they devised was both simple and audacious. It centered on a crucial expense in the telecom industry: line costs. These are the fees a company pays to other carriers to use their network infrastructure. According to generally accepted accounting principles, or GAAP, these are operating expenses that must be deducted from revenue, directly impacting the bottom line. But starting in mid-2001, Sullivan, under pressure from Ebbers, directed his accounting department to do something extraordinary. They began to reclassify billions of dollars in line costs as capital expenditures. Instead of being reported as immediate expenses, these costs were treated as long-term investments, spread out over many years. This single accounting trick had a magical effect on the company's financial statements. It artificially inflated WorldCom's assets, and more importantly, it erased massive expenses, creating the illusion of robust profitability where there was none. From 2001 through the first quarter of 2002, WorldCom reported over $5 billion in profits. The reality was a mounting pile of losses. The lie was working, but deep within the company, a small team of auditors was about to stumble upon the truth. The hero of this story is a woman who is simply doing her job. Cynthia Cooper, WorldCom's Vice President of Internal Audit, was known for her meticulous and uncompromising approach. In the spring of 2002, her team began a routine audit. But soon, they noticed anomalies that they couldn't ignore. A senior executive in the wireless division complained about having his capital expenditure budget slashed by CFO Scott Sullivan, who had personally reallocated the funds. Cooper's curiosity was piqued. Then, one of her auditors, Gene Morse, discovered a glaring problem: a mysterious accounting entry for $500 million labeled prepaid capacity. The entry had no supporting documentation and seemed to appear out of thin air. Cooper and her team decided to dig deeper, often working late into the night, in secret, to avoid arousing suspicion from Sullivan and his inner circle. They knew they were treading on dangerous ground. As they peeled back the layers of the company's books, they uncovered a pattern of deception. They found billions of dollars in operating expenses that had been improperly capitalized. When Cooper confronted Scott Sullivan, he tried to explain it away, telling her to back off and that the entries were not her concern. But Cooper persisted. The more she and her team investigated, the larger the fraud appeared. They were looking at a multi-billion-dollar hole in the company's finances. Realizing the magnitude of what they had found, and fearing that the evidence might be destroyed, Cooper made a courageous decision. She bypassed Sullivan and took her findings directly to WorldCom's board of directors. On June 25, 2002, the House of Cards came crashing down. Following an emergency board meeting, WorldCom made a stunning announcement. It had discovered over $3.8 billion in fraudulent balance sheet entries. The company admitted it would have to restate its financial results for the previous 5 quarters. The market's reaction was swift and brutal. WorldCom's stock, which had once traded at over $60 per share, plummeted to less than $1, wiping out over $180 billion in shareholder value.
The Securities and Exchange Commission immediately filed fraud charges.
Just 1 month later, on July 21, 2002, WorldCom filed for Chapter 11 bankruptcy protection. It was, at the time, the largest corporate bankruptcy in U.S. history. The fallout was catastrophic. Tens of thousands of employees lost their jobs and their life savings, which were tied up in now worthless company stock. Investors, from large institutions to ordinary individuals, saw their investments evaporate overnight. The name WorldCom became synonymous with corporate greed and corruption. The legal system moved swiftly to hold the architects of the fraud accountable. CFO Scott Sullivan was fired and later pleaded guilty, agreeing to testify against his former boss. Other accountants who participated in the scheme also pleaded guilty and cooperated with prosecutors. The main target, however, was CEO Bernie Ebbers. In 2005, he was brought to trial on charges of fraud, conspiracy, and filing false documents with regulators. His defense team portrayed him as a hands-off leader who was unaware of the accounting details, claiming he had been deceived by Sullivan. But the prosecution painted a different picture, arguing that Ebbers was the driving force behind the fraud, a demanding leader obsessed with the company's stock price. The jury agreed. Bernie Ebbers was found guilty on all counts and sentenced to 25 years in federal prison. The verdict sent a powerful message to corporate America: no one is above the law. The WorldCom scandal, along with the collapse of Enron just months earlier, exposed deep-seated flaws in corporate governance and accounting oversight. The public outcry for reform was deafening. In response, the U.S. Congress passed the Sarbanes-Oxley Act of 2002, the most significant piece of securities legislation in decades. The act imposed strict new rules on public companies, their boards, and their accounting firms. It required CEOs and CFOs to personally certify the accuracy of their financial statements, created the Public Company Accounting Oversight Board to police the auditors, and introduced tougher criminal penalties for securities fraud. The legacy of WorldCom is a cautionary tale of how the pressure to succeed can lead to catastrophic failure. It's a story of deception on an epic scale, but it is also a story of courage, the courage of Cynthia Cooper and her team, who risked their careers to uncover the truth. Their actions reshaped the landscape of corporate accountability, leaving a lasting impact that continues to protect investors and uphold the integrity of our financial markets to this day.